Stock splits can make investors choke on their coffee. Last time I checked, Netflix stock was trading at $1,100 per share. Now it's at $110, a drop of 90%. Should I buy on the dip, sell before it gets worse, or take a deep breath, check what happened, and not panic? Here's how a stock split works. It restates both the present and the past. I bought 11 shares in Netflix back in April 2021 at $486 per share, a total investment of just over $5,300. By early November 2025, the share price had risen to $1,100 per share, and the value of my investment was over $12,000. A return of more than $6,700, or 126%. Not bad. When the stock split happened, some of those numbers changed and others didn't. This is the information that was showing in my account after the split. The number of shares that I own has been multiplied by a factor of 10. Both the historical share price and the current share price have been divided by a factor of 10. The historical value has stayed the same, the current value has stayed the same, and the returns remain the same. That's how it looks for an individual investor. When we look at the bigger picture of some of the key financial metrics for Netflix, we see earnings per share for the previous year getting divided by 10, and the stock count multiplied by 10. The dividend was 0 before the split, and dividing 0 by 10 keeps it at 0. The dividend yield, which is the dividend amount divided by the share price, stays the same, as both the dividend as well as the share price were divided by 10. The market capitalization, which is the total value of the outstanding stock, stays the same. The number of shares has been multiplied by 10, while the share price was divided by 10, so the outcome is the same. A stock split does not change the fundamentals of the company. Why do companies announce and implement stock splits? According to the Netflix press release, the purpose of the stock split is to reset the market price of the company's common stock to a range that will be more accessible. Let's walk through the logic of that accessibility or affordability argument. If you invest through a traditional broker before the split and you want to invest $1,000 in Netflix while the share price was at $1,100, you could afford 0 shares. After the split, if you want to invest $1,000 in Netflix while the share price was at $110, you could buy 9 shares and have $10 left. Before the split, Netflix stock may have been unaffordable to retail investors like you and me, while after the split, it is affordable. More investors able to buy the stock, more trades, more liquidity in the market. That's a good thing. If you invest through a modern broker before the split and you want to invest $1,000 in Netflix while the share price was at $1,100, you could buy 0.909 shares. After the split, if you want to invest $1,000 in Netflix while the share price was at $110, you could buy 9.09 shares. With modern brokers that offer fractional shares, retail investors like you and me can buy Netflix stock both before and after the stock split. With fractional shares, the accessibility argument disappears. So are stock splits still worth doing? Well, first of all, they generate a lot of media attention, with all of the major financial news websites commenting on the news. Positive media attention is a good thing for a company. And stock splits can make a company look successful by association. Alphabet Inc. does it, Amazon does it, Nvidia does it, Apple does it, Tesla does it. Each of these companies had their share price going up when business was booming and financial results were strong. Splitting the stock after those successful runs is seen as a sign of strength. Something investors get excited about, hoping for the share price to continue to rise in the future.